So let's take an example of an income statement. The income statement is a report that is taken over a particular period of time, whether it's 30 days, whether it's a quarter, half a year, 5 years, a decade, etc. So the idea behind this statement is that it's, again, measured over a period of time. So as we interpret and we go through these different line items, we first define revenue as the receipt of payments or the promise of payments on sales that you have made during the period of time. So the example here is if you have a $500 widget, you sell it to a customer, and they pay you $500 for the sale of the widget in the period of time, then you book a $500 sale. In addition to, if you have a $500 widget, you charge $25 up front and you collect the rest as a note or a payable to your customer or receivable to you, you still book the entire $500 as the sale. So it doesn't matter whether you've collected it all or not, the revenue is generated because of the payment or the promise of payment because of a sale that has occurred. Next is cost of goods sold. Cost of goods sold is defined as the cost that it takes to procure, fulfill, or deliver a specific sale or a number of sales. So the idea here behind cost of goods sold is that these are activities or labor or products or items that you look to procure for the purpose of delivering your final finished product or service to your customer. And the way you test for them is that the way you know you have a cost of goods sold is that the more sales you have, the more of these things you need. If you resell light bulbs, for instance, if you sell lighting fixtures with light bulbs in them, a cost of goods sold would be the light, and you don't make light bulbs, obviously. The cost of goods sold would be the light bulbs that you've purchased from the vendor to turn around and add to your process or service, your product or service, to sell to your consumer. So if you have more sales of your lighting fixture kits, you would have to buy more of your vendor produced light bulbs to put into your final sale product. So the idea here is the more you sell, the more of your cost of goods sold you have to procure or engage or deliver. Cost of goods sold can also include labor and material. So if you have people that are subcontractors working on specific saleable items that you provide to your customer, these can also potentially be cost of goods sold items for you. Again, the idea behind the cost of goods sold is the purest ones, and we'll show a little bit later why it's a bit of a conversation. Some businesses will have cost of goods sold while the same items for other businesses will be expenses, and we'll explain why it's a bit of a conversation. You and your team and your accountant get to decide which categories serve for what purposes. But the purest cost of goods sold that we come across come in the form of a variable charge that happens consistent with the amount or volume of sales that you have. Once the cost of goods sold, and so the reason that I think about it this way, you look at your cost of goods sold as the cost to provide, to fulfill, to engage, or to deliver to your customer. And that's about the service fulfillment or the product fulfillment efficiency. You get that number right, you subtract it from your revenue, you're left with something called variable margin or gross profit. That gross profit gives you an idea of the impact of fulfilling on your sales and what's left over to now begin to handle your normal business operational expenses. The normal business operational expenses, the things that come up every single month, like rent and light and phones, those are considered overhead or overhead expenses. And they are a function of your business management acumen. So once you take your gross margin or your variable margin, same thing, and you subtract your overhead from that number, you get what's called your operating profit. In this case, variable margin was $4,000. Again, revenue was $10,000. The cost of goods sold was $6,000, meaning that we had a variable margin of $4,000 or a gross profit of $4,000. In this example, your overhead was $3,550, which meant that your operating profit at the end of the period was $450. Then comes your activities that don't have anything to do with business operation but affect your profitability as a company. And examples of these kinds of things include other income, other expenses, interest expense, if you have an overage or a loss from the sale of assets that are not a part of your normal business operation, they would come into this category. So again, these are activities that don't have anything to do with your normal business operation. They show up near the bottom of the profit and loss statement in the other income, other expense category. In this case, we have interest expense in this example of $50. When you take the operating profit and you might subtract that $50 interest expense, we get a pre-tax profit of $400. Now, is that cash? We'll show you later in this module why that is not necessarily cash, and most likely is not cash. Because you have interest, I'll tell you why that's probably not cash. So in this particular instance, the business efficiency of the sales over the delivery of goods or services sold was $4,000 or 40%. Then when you interacted with the overhead expenses of the business, we got down to an operating profit of about $450. And then when you subtracted the non-business operational expenses, you are left with a $400 pre-tax profit, which is an efficiency commentary on whether or not you have the potential to have a sustainable business. And the indication is maybe with a more positive nudge. We need to find out from the cash flow statement, which we'll talk about in a later module, as to whether or not your business will actually stick around, because you can be profitable and still lose money if you do other things wrong. So at least this is telling you that from an operational standpoint, if everything else is perfect, you have a business that likely will sustain or create profit and create and turn profit into potential cash flow. If this number is positive, then you at least have a chance. That pre-tax profit number, if you are profitable, then you at least have a chance for sustainability. If you are negative, if you're negative for too long, then there are other things you have to fix before you can become cash flow positive. So a positive number here can be a good thing. You need to go to another report to find out. A negative number here is something you have to fix unless you've planned for it over time. A company can afford to be negative if it's well capitalized and if it's in its startup phase. If it is negative and stays negative, then you have a business that's not able to effectively transform revenue into profit, and at some point that business must stop. So that's how I'd love you to begin to interact with this particular interpretation of the bottom line number on your profit and loss statement. The profit is simply just an indication that your business is transforming revenue into profit. If the number is negative, you need to go look at something to see. If the number is negative for a long time, you need to make sure you do something to get something on that sheet to change, whether it's looking at your expenses, looking at your revenue, so the transformation effect becomes a positive one. And if you have positive profit, then you get to look to your cash flow statement as to whether or not you are effectively now transforming profit into usable cash flow.